Question 26 is about the preparation of the group financial statements of FD for the year to 31st of December 20X3. In particular, this is about the situation where we are reducing our shareholding in another company. So the background here is that FD originally acquired 80% of the ordinary share capital of BN. So based on that original investment, we would have said this gives FD control of BN, and therefore this would be accounted for as a subsidiary and full consolidation would be necessary. However, on the 1st of September 2000X3, FD sold 3/4 of those shares. This means that all they're left with is a 20% shareholding in BN. And at 20%, at best, all they have is significant influence over the other company, meaning that we would now equity account for this as an associate rather than consolidating it as a subsidiary. So in relation to what that means in full then, we need to reverse all of the entries that were made initially to account for the investment as a subsidiary. As part of this, we would end up calculating a gain or loss on the disposal and would recognise this in the statement of profit or loss. In place of accounting for the investment as a subsidiary, the remaining shareholding would now be accounted for using equity accounting as an investment and therefore recognised as an asset. So in this case, we're trying to identify which three statements are true. The first of these is that we would calculate a gain or loss on disposal, and as we said, yes, that is correct, we would need to do that. The second is that the fair value of the remaining holding would be the initial measurement of the financial asset to be recognised from the 1st of September 20X3. And again, this is true, that is exactly how we would account for the associate holding that we now have. In terms of the other remaining answers then, the third answer is that the gain on disposal calculation would reflect sales proceeds of $560,000 being netted against just 75% of the carrying value of the net assets. This is incorrect. What we would need to do is calculate the full gain on disposal and therefore taking out all of the carrying value of net assets, goodwill and NCI. So this one is definitely incorrect. The fourth option is that there is some goodwill remaining after the disposal, but part of the equity accounting method is that we don't recognise any goodwill. So again, once we're accounting for the investment as an associate, we would need to remove any traces of goodwill from the consolidated SFP. The final two options then refer to the non-controlling interest to be shown, but again, non-controlling interest relates to the consolidation process and how we account for subsidiaries. So just looking back through the question, it tells us that the balance on NCI just before the disposal of shares was $70,000, and it's that full $70,000 which we would need to reverse to cancel out of the SFP. So the final correct answer is that the NCI balance will be debited by that $70,000.